What's up, my financially savvy friends, and welcome back to Boss Economic World. It's Halloween, October 31st, 2025. And while the ghouls and goblins in Washington are busy playing their favorite game, government shutdown, leaving us without any official numbers on how the economy's doing, the rest of us are looking around and thinking, things feel weirdly okay? Normally, a government shutdown would be the scary monster under the bed. No data, no certainty, markets get jittery. But this time, it feels like we're at a Halloween party where the power's gone out, but someone brought a portable generator and the music is still blasting. That generator, my friends, is artificial intelligence. So today, we're going to do the job the government can't. We're going to peel back the layers on this strange economic onion and ask the trillion-dollar question: is AI the superhero saving the US economy from a 2025 slump, or is it just the sugar rush before a massive dot-com-style crash? Buckle up. This is the real ghost in the economic machine. Alright, let's get physical. When you think of AI, you probably picture a glowing brain in a jar or a robot from a sci-fi movie. But in the real world, the AI boom looks a lot less like the Terminator and a lot more like a Costco. A really, really big Costco. I'm talking about data centers. These are the giant, windowless warehouses springing up across the country, from the suburbs of Virginia to the plains of Iowa. If AI is the digital brain, these data centers are its insatiable, power-hungry stomach. And right now, business is booming. While the housing market is about as exciting as watching paint dry, construction spending on data centers is going vertical. As of this summer, we were on track to spend about $41 billion a year just building these massive sheds. Now, in the grand scheme of the multi-trillion-dollar US economy, that might sound like a rounding error. It's less than 5% of all private construction. But here's the kicker: it's the only part that's growing. While other construction sectors are shrinking, data centers are single-handedly propping up the building industry, adding about 0.1% to GDP all by themselves. It's like being on a basketball team where 4 players are sitting on the bench, but one guy is just hitting 3-pointers from half-court all night long. That guy is data center construction. But the real story isn't the concrete and steel boxes. It's what goes inside them. This is where the numbers get truly insane. Investment in what the bean counters call information processing equipment and software, that's your servers, your networking gear, and most importantly, those glorious, high-powered NVIDIA and AMD chips, has gone completely parabolic. Just look at the big three: Google, Microsoft, and Meta. These tech titans dropped a combined $78 billion on capital spending in the third quarter alone. Let me repeat that. $78 billion. In 3 months. That's nearly double what they spent in the same quarter last year. Microsoft is building a data center campus in rural Wyoming the size of a small town, promising to bring hundreds of jobs and a Texas-sized electricity bill. Meta, not to be outdone, has basically bought up half of Ohio for its server farms. This spending spree is so massive, its contribution to GDP growth in the first half of 2025 was the biggest we've seen in decades. We're talking levels that rival the peak of the late 1990s dot-com boom. You remember that, right? When companies were spending billions on servers to sell dog food online? Yeah, it's that kind of frenzy all over again. The Atlanta Fed's GDP. Let's do some simple GDP math. GDP equals consumption plus investment plus government spending plus exports imports. That last part, XM, is key. When we buy a ton of stuff from other countries, that M gets bigger, and our GDP gets smaller. It's a drag on growth. Given that a huge chunk of the GPUs, servers, and circuit boards powering this AI boom are imported, you'd expect this to be a major headwind. And it gets even spicier when you remember the trade war. President Trump's administration slapped tariffs on all sorts of goods from China and elsewhere. You'd think that would make building an AI empire prohibitively expensive. But here's the plot twist, the classic moment of political pragmatism or hypocrisy, depending on your mood. The administration, while talking a big game about tariffs and protecting American industry, very quietly granted tariff exclusions for the exact hardware that data centers need. Circuit boards, servers, networking components, you name it. As Joseph Politano of Apricitas Economics put it, the current AI boom would simply be impossible if tech companies had to pay the same tariffs that car manufacturers or home builders currently face. Think about that. We're making it more expensive to build a house or a car with imported parts, but if you're Google building a digital god in the desert, you get a hall pass. Why? Because, as Politano says, the administration doesn't want to kill America's golden geese. So, you have this bizarre situation where the investment part of the GDP equation is soaring thanks to AI, and the imports part isn't dragging it down as much as it should because of a political loophole. When you do the math, Bloomberg Economics estimates the net contribution to growth from AI capital spending was about 1 percentage point in the first half of 2025. They think that will climb to 1.5% next year. This is the engine, folks. A massive private investment boom, quietly subsidized by a trade policy exemption. It's the secret sauce that's keeping the American economy humming. Now Model, one of the few real-time indicators we have left, was predicting that business equipment spending would blow past the second quarter's already hot 8.5% growth rate. So, when Harvard economist Karen Dinan says that in a mechanical sense it's fair to say that AI has been the main driver of US GDP growth this year, she's not kidding. Economists estimate that this AI investment boom accounted for more than half of America's 1.6% growth rate in the first half of the year. Without AI, we'd be flirting with a recession. With AI, we're the envy of the developed world. But wait, I hear the skeptics in the back. Boss, you're saying, a lot of that high-tech gear isn't made in America. It's made in Taiwan, South Korea, and Malaysia. Shouldn't that subtract from GDP? And you, my sharp-eyed friend, would be absolutely right. Okay, so we've established that big tech is on a spending spree of historic proportions. But that's just the direct impact. The ripples from this splash are spreading across the economy in some very interesting, and potentially dangerous, ways. First, let's talk about the wealth effect. This is a fancy term for a simple idea: when your stocks go up, you feel richer, and you spend more money. The S&P 500 is up almost 20% in the last year. But it's not a broad-based rally. It's a story about a handful of stocks. Let's call them the AI ascendancy: Nvidia, Microsoft, Alphabet, Amazon, and a few other tech darlings. These are the companies that investors believe will print money in the age of AI, and their stock prices have gone to the moon. So, who owns these stocks? Well, not everyone. The top 1/5 of Americans by income own more than 85% of all US equities. So when AI stocks boom, it's a small slice of the population that sees their brokerage accounts swell. But that small slice has a big impact on spending. JP Morgan Chase did the math on this. They found that a basket of just 30 AI-linked stocks created over $5 trillion in new paper wealth over the past year. They estimate this fueled about $180 billion in extra consumer spending. That's enough to account for roughly 1/6 of the entire increase in consumption over the last year. This is Chad from Greenwich seeing his portfolio jump 30% and deciding he definitely needs that new Porsche Taycan. This isn't your grandma getting a bigger social security check and buying more groceries. This is a concentrated boom at the top end that's driving a significant chunk of consumer demand. And as JP Morgan warns, a reversal in AI enthusiasm could turn this whole dynamic on its head, sucking that spending right out of the economy. But there's a much more tangible, and potentially problematic, ripple effect: electricity. Data centers are thirsty. Incredibly thirsty. They consume staggering amounts of power, 24/7, to run and cool all those high-performance chips. And the demand is exploding. Just this week, an Iowa nuclear plant announced its reopening, not to power homes or factories, but chiefly to supply a massive Google data center complex nearby. This is the hidden cost of the AI boom. According to research firm Grid Strategies, we're looking at a nearly 16% increase in US electricity demand by 2029, led by these power-hungry data centers. The problem? Our grid is old. We haven't been building new power plants or transmission lines at nearly a fast enough pace. Rob Gramlich, the firm's founder, says it'll be very hard to meet that growth. And guess what happens when demand outstrips supply? Prices go up. For everyone. Your electricity bill in Virginia or Arizona might jump 15% next year, not because you're using more AC, but because Meta's new data center down the road is sucking up enough power to run a small city. And here's that tariff irony again. While the tech hardware gets a pass, the equipment needed to upgrade our power grid, like transformers and high-voltage wire, is subject to tariffs, which has raised capital costs by 8 to 10% according to Wood Mackenzie. We're encouraging the demand for electricity while simultaneously making it more expensive to produce it. It's a recipe for an energy crunch that could drag on the entire economy. This is the big one. The question that keeps people up at night. For every dollar we invest in AI, is that a dollar invested in making a human worker obsolete? The fears aren't just hypothetical. This week, Amazon, whose CEO has been very vocal about AI's potential to reshape the workforce, announced it was cutting 14,000 corporate jobs. The rumor on the street is that a new internal AI, codenamed Project Oracle, is now handling most of their Q4 logistics and inventory forecasting, making thousands of human analysts redundant. A few days earlier, General Motors laid off hundreds of salaried staff, explicitly stating they were looking for efficiency gains in white-collar positions. For years, the narrative was that robots would take the repetitive, blue-collar factory jobs. But the first wave of the generative AI revolution is proving that wrong. It's coming for the spreadsheets, the presentations, the code, the marketing copy, and the legal documents first. The robots are coming for the cubicles. Now, without official labor market data, it's hard to see the big picture. But Bank of America did a deep dive last month, scouring survey data. Their conclusion? So far, there's no obvious link between industries adopting AI and weaker job growth. In fact, some white-collar sectors that are heavy AI users have still been adding jobs. But, and this is a huge but, that's during the good times. That's while the AI investment boom is creating jobs in construction and tech. The B of A economists wisely caution that firms may adopt a different strategy if an economic downturn were to happen, with AI allowing for larger layoffs. Think about it. Right now, companies are in an end phase. They're hiring AI experts and keeping their existing staff to manage the transition. But when the economy turns sour, and the CFO is looking to cut costs, the calculus changes. It becomes an or phase. Do we keep a department of 50 analysts, or do we pay the subscription fee for an AI that can do 80% of their work? That's the real test, and it's one we haven't faced yet. So, where does this all leave us? We're standing at a fork in the road, with two very different futures ahead. Path A is the holy grail, the productivity boom. This is the dream. The reason we get excited about technology in the first place. The idea is that AI won't just be an investment story, it will fundamentally make the entire economy more efficient. It will allow a scientist to discover a new drug in a week instead of a year. It will let a small business create a global marketing campaign with a few prompts. It's about making more stuff, with less effort, which leads to higher profits, higher wages, and a better standard of living for everyone. The Penn-Wharton budget model tried to quantify this. They project the AI boost to productivity will peak early next decade, adding an extra 0.2 percentage points to annual growth, and cumulatively adding 3% to US GDP by 2055. It's not a world-changing explosion, but it's a significant, sustained lift. But then there's Path B, the hangover. The dot-com bust 2.0. This is the skeptical view, and it has a lot of history on its side. Jerry Kaplan, a Silicon Valley veteran who's seen these cycles before, is waving a giant red flag. He looks at the billions being poured into data centers and is reminded of the 90s. He says, everybody thought the internet was going to require more computing power and more bandwidth than it actually did. The same thing's happening today. The argument is that we are in a phase of massive, speculative overinvestment. We're building 1,000 state-of-the-art kitchens before we have any chefs or recipes. Companies are spending billions on AI infrastructure because of FOMO, fear of missing out, not because they have a clear, profitable plan for how to use it. Eventually, the shareholders will start asking, where's the return on this $78 billion investment? And if the answer isn't there, the spending stops. The AI stocks crash. The wealth effect reverses. And the whole thing comes tumbling down. So, what's the verdict? Right now, the US economy is a high-wire act, and AI is the balancing pole. It's providing a massive, concentrated boost through investment. It's fueling a wealth effect that's propping up consumer spending, at least for the rich. But it's also creating serious risks. A looming energy crisis, a widening gap between the asset-rich and everyone else, and the existential threat to millions of white-collar jobs. Is AI the engine of a new golden age or a speculative bubble fueled by cheap money and hype? The truth, as always, is probably somewhere in the messy middle. It will likely create both incredible productivity and a painful bust in some sectors. But here's what to watch. Don't listen to the hype. Watch the profits of the companies using AI, not just the ones selling it. Watch the power grid and your utility bill. Watch the job numbers for accountants, lawyers, and coders. Because when the investment stops paying for itself, that's when the music stops. And you don't want to be the last one on the dance floor when the lights come on. Stay sharp, bosses. I'll see you next time.